Welcome to the True Talk Show. I am your host, Sharyn Rigsbee, and in the True Talk seat, I have a very special guest. He is a HECM Specialist for the Mutual of Omaha Mortgage, Mr. Bill Cavanaugh. Welcome to the show. Thank you for being here. For our viewers today, tell them a little bit about your background and how you're in this kind of financial space.
Yeah, so I've been doing HECM loans now for 17 years. I got in it through a friend of mine who's been in it for longer than that. So I've seen a lot of different things change with the program. But I've been helping seniors now for all that time to utilize their home equity.
Right on. So you may be asking, HECM, have I heard that before, or what is it? What is HECM? Explain that to it.
Yeah, so the question we get is, what the heck's a HECM, right?
What is it?
So HECM is an acronym for a home equity conversion mortgage. It is a mortgage. That's a very important point. It is a loan that's designed for 62 and over to access equity in your home, or to use equity in your home, to buy a home or to refinance a home, depending on what they want to do.
Are there two different loan products though? Is one for buying and there is one for refinancing?
Yeah, there's the HECM for purchase is obviously to purchase a home.
Okay.
And then what people have heard before is a reverse mortgage.
Yes.
That is a refinance loan. And that is used for people that are in their house. They want to stay in that house, but they want to access equity. That's what a reverse mortgage would be.
Let's talk about the one for purchase. How do folks access this, and how does this actual loan product work?
Yeah, so the HECM for purchase has been around now. It started in 2009, so it's only been around since the 11th year of the product. And it is a loan product designed for people that are 62 and over.
Okay.
If it's a couple, one of them has to be 62.
Okay.
And what it is based on their age of the youngest borrower, the value of the home, and wherever interest rates tend to be at that time, there's a down payment amount that's calculated based on the purchase price.
Okay.
So they bring that one-time down payment, and then for as long as they live in that property, as long as one of them lives there, they're not required to make any mortgage payment. They pay taxes and insurance and HOA fees if those are applicable, but there's no need to make a mortgage payment for as long as they live in that property.
Now I have to address this because that sounds too good to be true, and you probably hear this often.
Yeah.
How does that work where they don't have a mortgage payment? Because that's obviously what makes this really appealing at this time. So how is that possible?
So if you look at a conventional mortgage, if you borrow $100,000 to buy a house, what do you do every month? You make a mortgage payment.
A mortgage payment.
And you slowly pay down that mortgage amount.
Right.
After 30 years, you pay off your mortgage. What people don't realize is if you pay on a mortgage for 30 years, you're paying back 2 to 2.5 times that $100,000.
Right.
And that's just how you do it, right? That's how the bank makes money. So we're still a mortgage bank, and we make money on the interest. But with a HECM for purchase, since you're not making a monthly payment, the interest accrues on your mortgage balance. So your mortgage balance goes up over time. And then when you eventually sell the home, you pay off whatever the mortgage amount, so it would be the initial mortgage amount plus the interest that's accrued. And then whatever's left over goes to the estate or the kids, whatever the situation is at that time.
Awesome. Let's talk about the HECM for refinance, because they're different. Talk a little bit about how that works and who would be ideal for utilizing that loan product.
Yeah, so that product is for people that it's for somebody that's in a house they want to stay in. They're not looking to move, and they may have significant equity in that house. The average 65-year-old couple right now has about 68% of their net worth is home equity. It's the largest asset for most people is their home equity. So if somebody lives in a house and they want to tap into that, it may be to pay off a small mortgage, and maybe just to increase cash flow each month. Based on the youngest person's age and the value of the home, they get access to a percentage of their equity. And they can use that money for whatever they want to use it for. It's tax-free since it's equity. And it's a very flexible product. They can take a monthly payment, they can take a lump sum. There's a lot of different things that they can do with that product.
So it sounds like you can customize that based on maybe the needs of the person that you're connecting with then. There's some level of maybe customization to it, it sounds like?
There is. Everybody's situation is different. So it just depends on what they're trying to accomplish.
Awesome. So I have to ask, because I just wonder if some of our viewers have heard this. When you mentioned that reverse mortgage, I've heard that before. And there's kind of been some of the negative side of things that folks have heard, that if you do this product, and we'll just leave it vague there, that people are going to lose their home if they do a product like this. Is that the case, or can you help? How do you address that if someone's coming to you interested but very cautious?
And they should be cautious. I mean, any financial product you should be cautious about and get the facts. So we encourage people to get the facts. We spend a lot of our time educating. And so reverse mortgage is a slang term for a refinance loan. And the number one thing is we don't take the house. It's a mortgage, right? And we are in first lien position on the mortgage. And it has the same rules and regulations as any mortgage. You have to pay your taxes and insurance or HOA fees, which you do with any mortgage, or even if you don't have a mortgage, you have to pay your taxes and insurance. So the only way you can lose your house is if you don't pay your taxes and insurance, and that would be whether you had a HECM on it or not. Right. Yep.
Awesome. I hear you on that. What makes this different though? I mean, I think about a person who's the age that you mentioned could just do a conventional loan. Why would they not want to just go with a conventional, more traditional product than what you're speaking about today?
Because the biggest difference is the payment part of it. Okay. You know, a lot of people in retirement age are trying to reduce expenses, and mortgages are their number one expense for most people. So if they can eliminate, if they currently have a small mortgage, if they can eliminate that payment, it makes their life a lot easier. So that is obviously the biggest difference. What we have seen with some people is they may, when they do a more conventional product, making that monthly payment's not an issue, but 5 years down the road, 10 years down the road, things happen and it can become an issue. And then they may be in a bad spot at that time. So it's for people that are trying to cut down their expenses and just eliminate that part of it and have access to that equity.
That's good. So I'm thinking about who our audience is right now. I mean, we may have folks who are in this space who could use this product for themselves. We may even have other real estate agents or professionals who may want to know about this product. What could you say in like just a minute or so that could help them keep this top of mind thinking about your HECM product? How could they present this to a family member, parents, or even their clients that this could be a potential option for them to consider? Because I know for me, I've not heard about this until as of late, and you've mentioned it's been around for a little bit of time now. So what could you offer as a way to keep it top of mind to know this could be ideal for certain folks that we all connect with every day? Yeah,
so for a realtor, it would just be if you're looking at somebody who's looking on downsizing or right sizing, whatever you want to talk about. People that are looking to get out of a big house, their kids are now gone, they don't need the 3 or 4 bedrooms, they're looking for no maintenance or that type of thing, getting into a ranch, a condo, a patio home. What happens with people is they may not have looked at housing for a long time, and they start looking at what housing costs or a new house costs, and they're sticker shock. What they thought they may be able to afford, when they look at that price point, it's not what they want. So this product allows them to with the HECM for purchase, it essentially doubles their purchasing power. So if they've got $100,000 of money to spend, depending on their age, they may be able to buy a $200,000 home and not have a mortgage payment. So it just gives them more power to purchase and then not get tied down by that mortgage payment.
That's awesome. Well, there you have it. We have given you an option that can be really great if you're thinking about your parents, grandparents, if you're an agent, just another loan product that is really great. And I appreciate having you on the show because, again, I am one that has heard a very different side of this product, and hearing it from you, the expert in this space, was really, really good. So if folks have questions, Bill, and they want to reach out to you, not quite sure if this is a good fit for them or their clients or their family member, how can they connect with you outside of the show today if they have questions about the product?
Just send me an email, Bill Cavanaugh or bcavanaugh@mutualmortgage.com.
Say it one more time.
bcavanaugh@mutualmortgage.com.
Awesome. Thank you so much for being on the show. Absolutely appreciate having you here. Connect with him if you have any questions on this product. I'm sure he will be happy to answer those questions for you. Bill, again, thanks for being on the show today.
Thank you, Sharyn.
Thank you so much.